Well, hello, beautiful people. This is Jessica Jones with Rebel Women Wealth, coming in for a little learning corner today. I would like to talk about mutual funds versus exchange traded funds, or ETFs. I get a lot of questions from clients about what the difference is and what's the best to invest in, how to invest, that sort of thing. Now, this is not investment advice because I give tailored investment financial advice, not blanket stuff. But for our purposes, this is just kind of a learning corner. So a mutual fund is a group of stocks and or bonds, okay? And it's a group of them, okay? It's a fund of stocks and or bonds. You can have a stock fund, you can have a bond fund, you can have one that's mixed with both in it. And same goes for an ETF. They're just a group of stocks or bonds, okay? Equities. So basically, the main difference between the two is a mutual fund is a more traditional recommendation for folks because it's an actively managed fund. So there are fund managers that are managing that fund, meaning moving stuff around within the fund, okay? So because of that, you pay a fee for that. You pay an internal charge, okay, called an expense ratio, and that is what pays those fund managers, all right? Now, some of these can be very high. Not all of them. Sometimes they're much lower, but they could be, 0.2%, 0.5%, 0.9%, 1.5%, okay? So these can really eat into your earnings. The other thing with a mutual fund that is a little more restrictive is that you can't buy and sell it all day long. It closes at the end of the day. So as opposed to an exchange traded fund, when I go to put that to sell a share of that fund, it'll happen right when I sell it. Whereas a mutual fund, I can put in the order to sell, but it won't sell till the end of the day. Okay, so a little bit different there. Exchange traded funds, or ETFs, tend to have lower internal charges as well because they are not actively managed by a fund manager. It's more of a passive. They'll rebalance it and that sort of thing. It's not like it just sits there and dies forever. It is managed, but it's not actively managed, so there's not as much movement in it. So consequently, typically an exchange traded fund is going to have a lower expense ratio because of that, because there's not active fund managers keeping eyes on it. All right. Now, the thing is, you can get virtually the same kind of funds with a mutual fund or an exchange traded fund, meaning you can get an S&P 500 fund in a mutual fund or in an exchange traded fund. So we just need to look at the expense ratios and see the performance and see if it's worth it to pay that higher charge with the mutual fund, or if an exchange traded fund is going to give you like pretty much the identical fund for much lower cost. All right, I hope this helps. If you have any questions, reach out. I'm going to talk some more about the different kinds of funds and index funds and sector funds and that sort of thing in a coming video too. All right, if you need help, ask. All right, you got this, babe. Have a wonderful day. Bye.